speaker introduction would also be done by NNC, and then we'll have the presentation by our guest speaker, who is no other but Folusha Akinyele. He has a CPA designation, and then we'll have the question and answers, and then open up for conversations. But before then, I want to do a quick introductions of the executives of NNC, as well as the executives of NIROW, who have put together this awesome program today. I'm going to start with, of course, in no particular order, the president of the NIROW, the Nigerian regions of Waterloo. Sorry about that. That is Fidelia Ukeje. I hope I got that pronunciation right. Please forgive me. I'm a Nigerian, but
Cindy, you should be fine.
My bloodstream is by you too. Okay, please go ahead to introduce yourself, and I would like that we pass on the baton to the next executive that is on without me having to prompt you. So go ahead, Fidelia. Thank you so much.
Awesome. Thank you very much. Can you hear me?
Yes, we can, loud and clear.
Awesome. Thank you, Cindy, for moderating this, and good morning, everyone. Thank you so much for joining. My name is Fidelia Okweje. I am the president of Nigerians in the region of Waterloo, and I'm just happy to be here to be able to, learn and just do life with us this morning. I'll pass it on to Uche before we introduce other executives. So,
All
Uche.
right, thank you.
Yes, thank you very much, President Fidelia, and good morning, everyone. It's a pleasure to be here. My name is Uche Kugo. I'm the president of Network of Nigerians in Canada. Forgive my background and my demeanor. I'm actually in between events, but because this is one very important event, I had to make a time to be here. I want to thank NIROW for this collaboration. It's our first collaboration. It's important for everyone to know. And this is a partnership that I know has come to stay and that will actually serve greater potentials for both organizations and, by extension, other organizations that will be joining down the line. We'll start pretty significant, and I know that others are watching. And after this event, I strongly believe that we'll begin to get a high sense of collaboration. As a matter of fact, I am actually just reading a message from another organization in lines with collaboration as a fallout of what we're doing today. So I'm super optimistic. I believe I have some officials of here. I don't know what the method is. Fidela, is it NIROW first and then NNC something? But I'm done with my introduction.
Go ahead. Call your folks. I'm just going to look through to see who's here. But yeah, if your folks are here, let them introduce themselves. That's fine.
Okay, I know I see a couple of them. So just unmute and introduce yourselves and your name and your office. Thank you.
Thank you so much for that powerful introduction, Uche. Definitely teamwork makes the dream work, and together everyone achieves more. That's why we're here. We're happy to see this fantastic collaboration amongst Nigerians in the diaspora. Over to NNC executives. If you're in, please feel free to go ahead, unmute, and introduce yourself.
Dudu, go ahead.
My name is Abimbola Babashola. I'm the Assistant Secretary General for Network of Nigerians in Canada, and I'm glad to be here. Thank you.
Thank you, Abimbola. Who would go next? Any other NNC executive in the house?
I don't see any yet. I know some are trying to join in, so please just go ahead.
All right, thank you. So I would hand it over to NIROW. Do we have the NIROW executives in house? Please go ahead to unmute.
We can start with you, and then Aisha can go next.
Okay. All right, Aisha, are you in the house?
Cindy,
yes, I'm here.
Okay, go ahead to introduce yourself.
Okay, I'm Aisha, program assistant for NIROW. I liaise between the members and the executives, and I wish us a fruitful webinar today.
Thank you, Aisha, for that outstanding introduction. So while we...
Can I?
Oh, we have someone else in? Oh, yes, please go ahead.
Behind the scenes, my name is Blessing. I support the leadership of NIROW. I also want to call out Rahim. I believe it's Rahim. I see Rahim Abioye, who is also one of the co-founders of NIROW, Nigerians in the region of Waterloo. And he still serves as a strategic leader with the organization. So Rahim, if you just want to introduce yourself, we'd like to honor our founders whenever they come around.
Thank you. Can you hear me?
We can
Loud
hear
and
you.
clear.
Okay, yeah. Thank you, Blessing, for calling me out. I was just gonna relax in bed and listen to what's going on and just keep in once in a while. But well, my name is Rahim Abioye. Like Blessing said, I was one of the co-founders and the first executive president of NIROW. Well, I guess I ran out of ideas and people like Blessing and now Fidelia took over. And they're doing a marvelous job with NIROW, as we all can attest to.
Thank you
Thank
very
you.
much, Rahim. Cindy.
All right, thank you so much, Rahim, for that brief introduction. You know the way when founders talk, you can feel it in the demeanor and the way they're relaxed. So thank you very much for introducing yourself. So if there's any other executive, please feel free. If there is no other person, we will just go ahead to proceed with the tax clinic. And as you jump in, please feel free to go ahead and introduce yourself in the chat session. Just your name and of course where you're joining us from. Now, first of all, I would like to quickly chip in that we are recording this session. So please, we indulge your permission for us to, ensure we continue recording this. We just thought it was, ethical. We communicate that accordingly. And then we would go ahead with the land acknowledgement, which will be read and spearheaded by the president of Network of Nigerians in Canada, NNC, Uche Okugo. Over to you, Uche.
Thank you, Cindy. And once again, good morning, everyone. Before I take the land acknowledgement, I would just like to briefly introduce NNC and also talk about the whole idea of respect for the lands as it emanates from the respect we as the Black community is beginning to get from the government of Canada at all levels. NNC is a not-for-profit organization established in 2019 under the Canada Not-for-Profit Act. Specifically, we established on the 31st of June. And so this year, we are celebrating half a decade, and we've got multiple events lined up, starting with the event on the 22nd of February, being our Black History Month Summit and Cultural Night. NNC generally engages in programs, events, and projects that altogether help first the Nigerian community and indeed the Black community work on our personal development as well as leadership skills. There are tons of projects that we are involved with right now, and the president of NIROW, Fidelia, happens to be part of most of those projects as well. And the whole idea is to ensure that down the line, you would have members of the Nigerian community, the Black community as well, engage at all levels so that we can finally have our place on that table. Because like it's popularly said, if you're not on the table where decisions are meted out, it means you are in the field where repercussions are received. For too long, we've received the repercussions, so now we are beginning to align ourselves to be on the table. So those decisions will effectively affect us positively. And talking about respect that the Black community is getting as we continue to align ourselves, I, alongside a couple of community leaders, were in Ottawa a couple of days ago, just on Wednesday, to attend the federal government's Black History Month celebration. And in that event, I saw the Black community unite. I saw the government of Canada give respect to the Black community. I mean, almost all the government officials at the federal level were present. Most MPs were present. In fact, it ran beyond just the Black community. There were people from all walks of life. And in that community, the federal government acknowledged the fact that they were slow in implementing the United Nations proclamation of 2015 to 2024 as the decade of people of African descent. And so what was done in that event is that the government extended Canada's version up until 2028, because Canada didn't take action on that until 2018, 3 years later. So just to ensure that we still have that 10-year window, the government is saying that our version of recognizing people of African descent will run to 2028. So what this means is the government will continue to implement policies, procedures, and programs to positively affect the Black community. And one of the key advantages out of that is, of course, there will be a lot of support for the Black community, whether not for profit, different groups as well, to access loans, grants, information, and to be part of programs that will do us well. So putting it out there for every community group to ensure that you keep your ears to the ground and be part of what has now been extended to 2028. Okay, I'll just read the land acknowledgement as it covers the Greater Toronto and Hamilton area. Providing a land acknowledgement at the beginning of an event or meetings gives time for reflection and demonstrates recognition of Indigenous lands, treaties, and peoples. It involves thinking about what happened in the past and what changes can be made going forward in order to further the reconciliation process. Land acknowledgements mark a small and important step in the process of reconciliation and building a positive relationship with Indigenous peoples. By making a land acknowledgement, you are taking part in an act of reconciliation, honoring the land and Indigenous presence, which dates back over 10,000 years. The region of Waterloo is situated on the Haldimand Tract, land that was granted to the Haudenosaunee of the Six Nations of the Grand River, and are within the territory of the Neutral, Anishinaabe, and Haudenosaunee peoples. We acknowledge the lands in and around the Greater Toronto area are the traditional lands territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis peoples. We also acknowledge that these lands are covered by Treaty 13 with the Mississaugas of the Credit. So thank you very much as we continue this morning.
Thank you so much, Uche, for that outstanding introduction of NNC, as well as for doing the land acknowledgements, which is, of course, very, very important in Canada here. Aside that, I probably would take the opportunity to also quickly introduce NIROW, because I would be doing a bit of injustice to NIROW after that wonderful wonderful introduction of NNC. So NIROW means Nigerians in the regions of Waterloo. If you're just hearing about it for the first time, was founded in 2015 by like-minded individuals like Rahim, who introduced himself at the onset of this workshop. And the purpose and vision of NIROW is to, of course, foster a thriving community for Nigerians in the region, and of course, build a formidable force that would, contribute to the development of the region as a whole. So I want to thank everyone again for joining us today, and I would go on straight to quickly put out a few housekeeping rules. First of all, please ensure that as you join in, you introduce yourself. That is not here, but please introduce yourself. You never know who you would meet, probably an old friend, an old colleague, or you might just network with someone new. Secondly, please ensure that your device is muted. We want to, as much as possible, reduce disruptions during the workshop so that everyone can effectively get some learning from this workshop. We also encourage you to turn on your cameras. Come on. If maybe you're still wearing your cap, you can even be in bed. You saw Rahim come up and he still spoke, so it's fine. We see this place as a safe space. Please switch on your cameras. Let's get to see faces. Not every day we get to meet people. Sometimes we're just buried in work, so this is an opportunity for us to see everyone's faces and not just black tiles. Please use the raise your hand icon. You would find that in the reactions button. When you want to speak, raise your hand. Try not to interject the speaker when the speaker is talking. And finally, all opinions are valid. Please ensure that you respect everyone's opinions. That is very crucial and critical. And finally, I want to buttress that we ensure respect, while speaking and while passing on our opinions, or while asking questions. Thank you so much for adhering to our housekeeping rules. Next, we are going to go ahead to introduce the speaker. I would pass on to, I would request for Aisha to go ahead to do that introduction, please.
Can I quickly ask, Uche, is the secretary here? Is she on the call?
Yes, I am. NNC secretary?
Yes.
Yes. Okay. Introduce the speaker.
Okay.
Okay.
Folusho Akinyele is the founder of FAB CPA Professional Corporation, an independent accounting, bookkeeping, and tax specializing in helping small and medium-sized enterprise to balance their books, prepare financial statements, process payroll for their corporate, sales, and personal taxes. Folusho provides tax planning, bookkeeping, and accounting payroll services and corporate income tax services for SMEs, as well as personal income tax services for individuals. Along with her current role as the founder of FAB CPA, she holds and has held various leadership positions in large international corporations in a variety of industries, and has also worked with Canada Revenue Agency. Folusho's experience include finance, accounting, tax, personal, corporate sales, tax, operations, investment control, and strategy. A strategic thinker and a creative problem solver with intelligence and sound judgment. She has been awarded the CPA and CFA designation and also possesses an MBA and bachelor's in accounting. She has also completed a Canadian Payroll Association's Payroll Compliance Practitioner certification. Building long-term relationship and providing the very best services possible is a number one priority. We welcome Folusho Akinyele.
Thank you so much for that outstanding introduction, Abimbola. Welcome, Folusho Akinyele. Very intimidating profile. Please feel free to use the reaction button to give her a round of applause. Please use the celebration icon, whichever one works for you. Just go into the reaction button and put something there for Folusho. Welcome, Folusho.
Thank you very much.
Yes, we are so happy to have you here. Over to you.
Yeah, thank you so much. And thanks for the introduction, Abimbola. It's a privilege to be able to share my experience and my knowledge with my fellow countrymen. So I'm glad to be here. So I'm going to go quickly into the presentation. I'm just going to tell you a bit on how it would run. I would do a bit of like an introduction to the Canadian income tax system, and then I'll bring it down to, tips and things that, various people in different categories of their lives in Canada, should look out for when filing taxes. And then I'll give an update with regards to 2023 and what are the changes from prior years. Yeah, so this would be useful for both the newcomers and people who have been in Canada for a while and have been filing taxes as well. And at the end of the session, we'll take questions and I'll be able to answer whatever questions you might have. So I'm just going to share my screen. One sec. Let's see. Okay, can you see my screen? Yeah, okay. So this year's title is Tax Filing with a Smile. Hopefully we would all smile to the bank when we file our taxes this year. Okay, so I'm just going to go quickly into the Canadian income tax system and how it works. So the Canadian income tax system is based on self-assessment, and what that means is that you are responsible for filing complete and accurate taxes. But usually the CRA can help you along the way. So the way it works is that institutions, employers, organizations would report tax slips to the CRA. So the CRA would also, so when you file your tax return, the CRA also knows what you have, because the financial institutions, your organizations would have sent them copies of those tax slips they sent to you, and then they would do a matching program to be sure that you are filing all your taxes, or you're reporting all your income as you go. If you're not, then they would actually come back to reassess you, and we'll talk a bit more about reassessment later. And then we also, and those are the ones that are pretty much structured. What we also have is business, rental income, or some other kinds of incomes where the CRA has limited or no information on these types of income. So it's up to you to, put in information as accurately as possible. And because the CRA doesn't really have so much oversight on that, when they do find defaults or that people haven't properly filed those income, there are usually harsher penalties for them. Okay, and then the CR and the Canadian income tax system as well also uses deductions and tax credits, and deductions and tax credits are entirely up to you to claim properly. So I will talk a bit more about that. So where you have children, there might be some, deductions you can claim. Where you have donations, there might be some tax credits you can claim. When you're a student, there's some tax credits you can claim. I will go more into that as we go along. Okay, so the question becomes, who must file a tax return? So people would usually ask, should I file a tax return? And the answer is yes, for various reasons. First of all, if you owe taxes, then the CRA would expect you to file a return. If you have self-employment income, even if you don't owe taxes, the CRA would expect that you would have to pay into the CPP system. So the Canada Pension Plan is Canada's technically like retirement system, where when you retire, you stop working at the age of 65, you can then begin to get paid something monthly. So they expect that everyone working, whether you're in paid employment or you're self-employed, would contribute to it while working, so that when you retire, you'll be able to get paid. The government will be able to pay you something every month. If you take money out of your RRSP, then you have to report that income on your tax return as well. The CRA could also request that you file a tax return. So sometimes CRA sends out letters, especially people who haven't done so. They might say, we haven't received your tax return for this year, or we haven't received your tax return for the last couple of years. We are requesting that you file it. And usually if you don't file it within some certain period of time, the CRA could do like an arbitrary tax filing for you, and they would just come up with numbers, maybe based on what you filed the last time, where they think you should be, and then they would send you an assessment asking you to pay. So we don't want to get to the point where the CRA is filing arbitrary tax returns for us. Okay, so why should you file a tax return? If you're expecting a refund, so if you've paid taxes throughout the year, you might be expecting a refund. So it's a no-brainer, you should file a tax return. If you're entitled to refundable tax credits, now refundable tax credits are those tax credits that whether or not you paid taxes during the year, you would get something back. A case in point would be the climate action incentive that people used to get when they file a tax return before. Now they do it quarterly. They pay you, quarterly for that. But previously, it would be a tax return you would get just for being a resident of a particular province. So those are the kinds of refundable tax credits I'm talking about. So for benefit entitlement as well. So many other tax credits are triggered by filing a tax return. CCB, GST, HST, OTB, or Ontario Trillium benefits, the childcare benefits are all triggered by filing a tax return. If you don't file a tax return, there's no way the CRA can determine what you're entitled to, so you don't get anything. So that's a good reason to file a tax return. And then income for RRSP purposes. So when you want to start building your RRSP room early, even if you have no taxes to pay, so you've earned income as a percentage, about 18% of that is usually added as your RRSP contribution room. So you might be able to use that in the future. So it's a good idea to actually file your tax return to be able to get that room. If you have losses to claim, you might think that there's no need to file a tax return if you've lost money. But guess what? You're able to carry some losses forward. You're able to carry some capital losses forward, some non-capital losses forward. So it's better to file that tax return so that you can use those losses to reduce your tax liability in the future. And then tuition credits for students. So students usually don't have income, but they have tuition credits, which they can carry forward to a time when they begin to earn income. So because you're a student, it's still advisable. You're not making any money, you're not earning anything, but you have those tuition credits, for instance, it's best that you file a tax return so you can use it in the future. Because if you don't, then when you begin to earn income, you won't be able to claim those tax credits if you didn't file a tax return in those years. Okay, so this year, the tax filing deadline is April 30th for individuals. For self-employed, it's June 15th, and also for the spouse of a self-employed individual, it's June 15th. However, payment due should be made by April 30th. So technically, if you're supposed to pay the amounts that you owe by the 30th of April, it then means that it makes sense for you to just file your tax return by the 30th of April. So the same thing for trust, you have 90 days after the year end of the trust, that's 3 months. For deceased taxpayers, it's April 30th or 6 months after the date of death. And there are penalties for late filing. So these are just the penalties, 5% of the balance owing. So technically about 17% after 1 year of not filing your tax return. But then if you do not owe taxes when you file late, because the CRA would only charge penalties on the amounts owing, you usually will not get a bill if you were supposed to get a refund or you had no taxes owing. But then at the point when you're filing a tax return, you're not sure whether before you file the tax return, you're not sure whether you're going to owe or not. So it's advisable you file it just in case you have amounts owing. It's better to, get it sorted out so you don't incur penalties and interest for it. Okay, now there are some certain individuals who have to pay installment payments, and installment payments is that maybe 4 times a year or twice a year, the CRA requires you to make installments into your CRA account. And that's usually for people who have owed large amounts in prior years. So if you maybe filed your tax return last year and you were probably owing like $6,000, then the CRA would ask you that, okay, so you paid the $6,000 right now, but then subsequently, if your situation is going to remain the same way, you're going to owe that much. Instead of waiting till you file your tax return and coughing up $6,000, they would ask you to pay it in installments. They will give you a schedule and with dates to let you know how you should make those installments. But then if you're sure that and then if you don't make those payments, when you do file your tax return and you owe over $3,000, then there'll be penalties for not making those installment payments. So you need to take note. However, if you believe that your tax situation has changed, you're not going to, or maybe the kind of income you earned in that year where you paid the $6,000, you're not going to earn it, or you've been able to structure things around where you're not going to owe up to $3,000, then you don't have to make those installment payments. Once the CRA takes a look at your tax return and they see that, okay, you didn't owe that much and all that, then they won't bother to charge you interest or penalties for not making those installments. And there are various ways you can file your tax return. You can file by paper, where you download the tax return forms and then you use your hand to write and do the calculations. It's the slowest method. First of all, I mean, it's a lot of work to do that. And then also it's slow because then you have to mail the tax return to the CRA. That would take time. Then when they get it, they would have to impute it into the system. So while the online ones take about 2 weeks, the paper one would take you about 6 to 8 weeks to get your notice of assessment. So it's usually not advisable. And then you can also do it by phone with File My Return, but this is more like an invitation. So the CRA determines who gets those invitations and where you can file your tax return. Usually it's people with low income, people with pretty much simple tax returns. So maybe the guys that receive CPP income, nothing complicated, they don't have properties, they don't have so many other things going on. They usually might get to file their return on the telephone. And then you can e-file with a tax preparer like me. So where you'd give us your documents, we would file it for you. And with that, you get improved accuracy, you get your faster returns because you get your notice of assessment and your refund within 2 weeks. It's paperless, you don't need to send anything to the CRA. So the only time you send the documents with we send the tax returns with the numbers, but then if the CRA wants to clarify, that's when they would request for the documents. So you don't send the documents along. Unlike on paper, if you're claiming a donation, for instance, you have to attach proof of that donation. If you're, whatever it is you're claiming, you need to add to it. And then you could also use one of those online softwares. And there's TurboTax, there is what's it called? Wealth Simple. There is H&R Block. Some of them are free, some of them are not. So it's also known as NetFile. It's faster as well. It takes about 2 weeks. It's paperless, and you would know immediately that it's been filed. Another option is a community volunteer income tax program, where if you go during the tax season, if you go to the libraries, you go to the community centers, you would see that some people are kind of set up. It's usually a free tax clinic, usually simple tax situations. If your tax situation is complex, you might not be able to get assistance from there. usually for people with modest income as well. So that's an option to file your tax return. And then for documentation, all information, all documents, all receipts should be kept for about 7 years, just in case the CRA decides to ask for evidence of some of the items you've claimed on your tax return. Okay, so the tax rates in Canada, so it's been adjusted to reflect inflation for 2023. So and this portion of the marginal taxes, the tax rate I'm talking about is the federal. Each province then has its own tax rate as well. So we get charged on our tax, but we pay taxes on the federal level. We also pay taxes on a provincial level as well. So the amounts you see in the boxes at the federal level, each province would have additional taxes that they do charge. So the first 15% of your taxable income, so the first 53K of your taxable income is charged at 15%. That's the tax rate. And then anything between 53K and 106K, it's charged at 20.5%. And then anything between 106K and 165K is charged at 26%. Anything between 165K and 235K is charged at 29%. And anything over 235K is charged at 33%. So the higher you go, your marginal tax rate will go up. So please note that if you earn let's give an example, 120K, the whole 120K will not be charged at 26% because it's in between 106 and 165. No. So that's not what I'm saying. What I'm saying is that out of that 120K, the first 53K of that 120K will be charged at 15%. Then the next about 53K will be charged at 20.5%. And then the difference between the 120K and the 106, so the next about 14K will be charged at 26%. So it's not a flat rate based on your income. It's, it graduates, right? The more you earn, the higher your marginal tax rate will be. Okay, so when you file your tax return, the evidence that you have filed a tax return is when you get a notice of assessment. You usually will get that within 2 weeks. If you file electronically, whether you use a e-filer or like a tax return preparer, or you do it yourself online. If you file with paper, it would take about 6 to 8 weeks to get it. And it's the most important document issued by the CRA. You should usually keep it for at least 3 years. You should keep it for more. So it usually tells you, gives you a summary of the taxes you have filed. It gives you what your RSP contribution room will be for the following year. It also proves that you have filed your tax return. So when you have banks, you want to get a mortgage, they would ask you to provide them with the most recent notice of assessment. So, it tells them what your income is and all that. So, so it's a third-party verification of your tax return. So if you cannot find yours, usually you should be able to log into your CRA account online to download a copy of your notice of assessment from prior years. But if you are unable to find yours, or you don't have access to your CRA account, you can always call the CRA and they can mail you a copy of the tax return. Sorry, they can mail you a copy of the notice of assessment. Okay. And then we also have a situation where we have notice of reassessment. And the notice of reassessment is after the notice of assessment has been received by you. For whatever reason, the CRA decides to reassess you. It could be because you realize that you made a mistake on your tax return and you ask them to adjust your tax return for you, then you will get a notice of a reassessment. Or it's also possible that you missed out some tax return and some tax slips when you were filing your tax return. The CRA noticed it, maybe you worked with, and this usually happens when, we worked with multiple employers in the year. So maybe I worked with a company from January to March, and I worked with another company from March to December. So and I still work with that company. So the company gave me a T4, my current employer, right? But then I didn't get the T4 from the prior employer that I worked with with January to March, and I didn't maybe remember that I worked there, and I just filed my tax return with just the T4 that I had. Whereas the CRA would most likely, both employers would most likely have sent both T4s to the CRA. So the CRA has assessed your return, they've given you a refund, and then they go back to check and they're like, wait, the income Felicia has put on her tax return, is less than what we were expecting. And they realize that. So they take that tax return from your previous employer, they recompute your numbers, and they send you a notice of reassessment. So that's the way it works. So usually you can file a notice of objection within 90 days if you do not agree with the notice of reassessment you have received from the CRA. So we can actually challenge the CRA if we do not agree with the changes. So maybe you do not agree with the way they have treated one of the items that we are assessing, you can always reach out to them and file a notice of objection for that. So in Canada, we majorly use a slip system of reporting. And what that means is that most of the employers will give you a T4, most of the financial institutions will give you a T5. For those who are retired, they will get a T4A, and then the school would give you a T2202. Your employer would give you for employment expenses a T2200. So all these tax slips, as you get a copy, the CRA gets a copy as well. Right? So they are able to track, if you're filing all your income. So the challenge usually is where you have to provide information like rental income and all those other kinds of incomes that are not on the slip. That's why the CRA is, the penalties for those ones will be harsher because, the onus was on you to ensure that you reported everything. Okay. Okay, so I said I'd mentioned earlier that I was going to talk about tax credits, and these are the personal tax credits. So we have the refundable and the non-refundable tax credits. So a non-refundable tax credit brings your tax liability to zero, but you don't get paid if it is higher. So what I mean is that if your tax liability was supposed to be $20 and you had a non-refundable tax credit of $10, it takes your tax liability to zero. You don't get the extra 10. That's what a non-refundable tax credit is. But refundable tax credits are paid even if there is no tax liability. So even if you're not owing taxes and you had a refundable tax credit, then you will get the money. You actually get the money for it, okay? And each tax credit has its own rules and eligibility requirements. We'll go through a bit of that as we go along, right? For us to take a look. So usually for tax credits, it's usually at the lowest federal tax bracket, even the provincial as well. What I mean is that whatever credits you're getting would be at the lowest tax rate. So if you're claiming a tax credit, it would be at 15% for federal, for instance. That's the way the CRA would handle that. Okay, let's see. So I'm going to talk about tax deductions and tax credits and what the difference is. I've talked about tax credits already, but tax deductions usually are basically tax savings at your marginal tax rate, and they are more lucrative. So it's a deduction. So the difference in a deduction and a tax credit is that for a deduction, it reduces your taxable income. And if your taxable income is reduced, it kind of pushes you to, so if for instance, you were in the third, a part of your income would have been in that third box that I showed you where it was 26%. If you had a tax deduction that took you out of that 106K income into maybe 100, so technically your marginal tax rate goes down because of that. So tax savings, so tax deductions are more lucrative, and examples of that would be RSP contributions that you make, childcare expenses, union and professional dues, moving expenses, employment expenses. Those kinds of amounts, those kind of deductions reduce your taxable income. But for tax credits, the savings are based on the lowest tax rate. And examples are the basic personal amount, the age amount, the tuition amounts, donation credits, spousal amounts. And we'll talk a bit more about all these kinds of tax credits as we go along. So here we are. So the basic personal amount. So everyone gets a basic personal amount tax credit. So it's available to all Canadian residents. This is sometimes referred to as a tax-free amount. So it's the income level where you start paying taxes. So for 2023, I believe it's 15,000. So anyone who earns between $1 and $15,000 in the year will not pay taxes. So anything above that is what begins to be taxed. So that's what the basic personal amount is. As long as you're a Canadian resident, you're entitled to a basic personal amount. Now, if you came within the year, the basic personal amount will be prorated. It's usually prorated based on how long you were a resident of Canada. And then we also have the Canada employment amount, and this can be claimed by any resident who has employment income. So this amount is about 1,200 or 1,300. It's so when I say the basic personal amount is 15,000, the tax credit on it will be 15% of 15,000. Because recall I had mentioned that the tax credits are the lowest tax rate, federal tax, which is 15%. So the same thing with the Canada employment. So when I say that the amount is 1,200, 15% of that 1,200 is what is actually the tax credit that you would get. And it's a way so the Canada employment amount is a way to level the playing field with those who can write off expenses, like, those in the self-employed guys. Okay, and then there's another, and then we have the CPP and EI premium tax credits, and these are credits for, making CPP contributions and credits for making EI contributions every year. So it's available to anyone who made CPP and EI contributions during the year, both for the employee and self-employed. And there's a maximum amount that is paid each year. So what happens is it's about 3,500 plus. That's the maximum amount that can be contributed for CPP. So in a situation where you have contributed more than that, probably because you had 2 employers during the year, or your employer didn't do the computations well and you had made those payments, what would happen is that the CRA would give you your money back, because you're not supposed to contribute more than a certain amount every year to CPP and EI. Okay. Yeah, like I mentioned, common ways to over-contribute, numerous jobs, or withholding the same amounts. Individual starts collecting CPP benefits, payroll calculation errors. Those are the reasons why, you might see that you have over-contributed to it. Okay, so union and professional dues are a kind of tax deduction. So usually there are fees and dues paid to trade unions for employment purposes. Sometimes for union dues, they usually show up on your tax slips, especially if you work for the government or you work for a unionized organization. They would have union dues that every member of the union would pay, and then you would see that on your T4 slip already. Now, professional fees and insurance, those are professional fees paid to an association for membership. So for instance, if you're a CPA, you make payments to CPA for your annual dues, you can deduct that on your tax return. If you were a lawyer and you're paying to the law board, you can deduct that as well. The same thing for liability insurance and all that. And then the fees and professional dues should be related to employment. Now, I want to put some caution on this, because I know that a lot of people, will say, I did PMP, I paid my dues for PMP or business analysis dues and all those kind of things. Those professional fees are actually not recognized by the CRA. They are, I guess maybe because they are not associations or memberships registered in Canada, so they don't have them on your radar. I know that a lot of people put it in, but usually if the CRA decides to review those professional fees or dues on your tax return, and you provide them with receipts for PMP and all those IIBA and all that, they usually disallow them. So I just wanted you to take note, that, if it's not registered in Canada, or there's a website actually that you can also check on the CRA website to see which ones might be. And if you're not sure, you can consult a tax consultant, also called the CRA, to confirm. Okay, so another popular one is the donation tax credit. So when we give to charities, we give, to support a cause, it applies only to registered Canadian charities. So you need to look for their registered charity number on their receipts. So churches usually come under this, because most churches usually would register for charity status. And then at the end of the year, they would give you, even mosques do it as well. At the end of the year, they would give you like a letter, like a donation receipt saying, oh, this is the total you contributed in that year. You would see their charity number. So with that, you can get a donation tax credit on your tax return. And there's some rules around it. Either spouse can claim the credit, or it can be split. So usually I advise that, one person claims it on their tax return. So you have a spouse, the spouse has maybe 2,000 in donations, and you have another 2,000 in donations. If you individually file your tax returns and you put your 2,000 on, and your spouse does the same thing, you're kind of leaving money on the table, because the way the donation tax is computed, it's better if you put it together as one. So I always advise either spouse can claim the credit. So what you can also do is that if the one spouse has claimed up to the maximum, that there's no benefit to it anymore, then you can transfer the rest to the other spouse or save it for the following year. And it can be claimed for 5 years. And there's a 75% income threshold limit. What that means is that your donations, your total donations in the year cannot be greater than 75% of your income, because they expect that if you donated over 75% of your income to donation, how are you surviving, right? So it's going to kind of look shady. So 75% is the income threshold for that. And then, so like I'd mentioned, if you're filing electronically, you don't need to submit the receipts, but the CRA usually comes back once in a while to kind of ask you to provide evidence of those donations. Okay, and then we have the medical expense tax credit as well. And this is where, when you pay out of pocket for when you pay medical expenses out of pocket, you're able to claim on your tax return. So maybe you paid for drugs, prescribed medication. Over-the-counter medications are not part of this. It's prescribed medications. You had to take a test that HIP didn't cover, or your provincial health didn't cover, those kind of expenses. Or you had to pay for health insurance out of pocket. So maybe you did like a personal health insurance for yourself outside of HIP. Those would fall under, you would be able to claim those, on your tax return. So there's a 12-month period rule, which says that you can claim any 12-month period as long as the last month ends in the current year. So basically what we're saying is that if I paid a large medical expense, for instance, in October, and I paid another large one in January of the following year, I can decide that my medical expense period starts from October to September of the following year. So as long as it falls into September of the year for which I'm filing a tax return, then I'll be able to claim, as long as it's a 12-month period, right? I'll be able to do that. And then you can claim medical expenses for you as a taxpayer, your spouse, your common law partner, your children, your children or your spouse's children at the age of 18, okay? And usually the medical expense tax credit is usually claimed on the tax return of the lower income spouse. That's the best way to get that's the most efficient way to get the best out of this medical expense tax credit. So if you have a large income, usually you might not be able to claim medical expenses, right? Because usually it's compared with 3% of the taxpayer's net income. So whichever is lower. So if your medical expense is $4,000, for instance, in a year, and 3% of your income for the year is $10,000, for instance, you will not qualify for the medical expense tax credit. Okay, I'm just going to try to move quickly so that we can move on to other things. So I'm going to talk about moving expenses. Now, moving expenses is a tax deduction. It's not a tax credit. So with the moving expenses, you would be able to deduct this amount from your taxable income, right? So who is entitled to moving expenses? So it's people who have moved or run a business or are in school full-time, and they have moved because of this reason. So they moved to work, to run a business, to study full-time at an educational institution, and they moved at least 40 kilometers closer to the new work location. So if you moved from Nigeria to Canada, you cannot claim moving expenses. But if you moved from maybe you were living in Toronto before, you got a job in Ottawa and you had to move to Ottawa to resume at that job, the moving expenses you incurred, for instance, to get closer to your job at Ottawa, you would be able to deduct on your tax return. And the expenses claimed are limited to the amount of eligible income earned at that new location. So if you earned in that new location the new place where you're working, if you earned $20,000 that year, then you cannot claim more than $20,000 in moving expenses, for instance. But the excess expenses can be carried forward to the next year, as long as you're still working in that organization. So how is 40 kilometers measured? Distance is usually measured by the shortest public route. So it is usually, what's the quickest way to get there? What's the shortest possible distance to get to that location. That's how we determine what the 40 kilometers would be. And then moving expenses can be claimed for family and household effects. So transportation and storage, traveling expenses, including vehicle expenses, cost up to 15 days for meals and temporary accommodation for you and your household, cost of canceling a lease for an old residence can be, if you had rented somewhere before and then you got a job and needed to move, you canceled your lease, they charged you, for, cutting your lease in between the period, you'll be able to claim that as a moving expense. However, if old residence is sold as a result of the move, eligible moving expenses can also include taxes and legal fees paid for the transfer, registration of title of new residence, cost of selling the old residence. You'll be able to claim that as well. Okay. So what are the moving expenses you cannot deduct? Expenses for work done to make former residence more sellable. You can claim that. Any loss from the sale of your home, you can claim that. Expenses for house hunting trips to your new location, you can claim that. Expenses for job hunting in another city, you can claim that. Expenses to clean or repair a former rented residence to meet the landlord standards, you can claim that. Mail forwarding costs cannot be claimed. Costs incurred to sell the home if the selling process delayed due to investment purposes. So for instance, you were moving, you wanted to sell your house, but the market is down. So you decided you weren't selling it. And then you waited maybe a couple of months or a year to sell. You then cannot claim moving expenses, on the cost incurred to actually sell those things. Okay. So there are different ways of filing reporting the moving expenses, a simplified method. I won't go into all that because of time. Okay, so I'm going to move straight into students. So what should students be looking at when they're filing their tax return? Okay, so I'd mentioned this when I talked about tax credit. So tuition, education, and textbook amounts. So this is reported on the T2202. Usually your school, your educational institution will issue you a slip at the end of February is when you usually would get the slip. Usually you'll be able to log into your school portal and actually download it. Okay, and then you fill out a Schedule 11. And this is very important because it tells you what the tax credit calculations would be, whether you're part-time or full-time, and all that would, be involved in that. And then I'd mentioned before, tuition tax credits, for instance, can be carried forward. So if you didn't earn any income this year, you can, file your tax return, including your tuition amount, and it will be carried forward. You can carry it, until whenever you use it. It's into perpetuity. Usually your notice of assessment would also report the carried forward balance. So when you file this year and maybe your tuition amount was $10,000, your notice of assessment will tell you that you have tuition amount of $20,000 you can carry to next year. And when you file next year again, and you have another $10,000 of tuition that you filed, it will now tell you that your total tuition amount is now $20,000 or $30,000. So it just keeps increasing. So whenever you start to work, you can use those tuition credits to reduce your tax liability. Okay. And then what also applies to students is interest on student loans. So usually I believe that when students get those loans, initially they don't charge interest, but then when you finish school, they begin to charge, especially with the OSAP and all, you begin to pay tax, you begin to pay interest on the amount that you owe. So the interest on those loans, you can claim on your tax return as a tax credit. Okay, so you cannot transfer to anyone else, but you can carry it forward for 5 years until it is used. And then when you borrow money, when you take personal loans or lines of credit that are not student loans, even though you used it, to further your studies or whatever, as long as they were not, student loans in the sense that, they follow the Student Loans Act, you won't be able to claim any interest on them on your tax return. Okay, and then you're also able to transfer your tuition amount. So who can you transfer it to? You can transfer to your spouse, you can transfer to your parents, you can transfer to your grandparents. So you're not using it, but you can transfer up to $5,000 per year to your spouse, your parent, your grandparent, or you can do that. And then so what would happen is there's usually on the T2202 form, there's a place where you can sign off and say that I'm transferring this amount up to a maximum of 5,000. So you can choose any amount in between to your spouse or to your parent or whoever, and you give that to that spouse or that parent. That's the proof that person can use in, including the 5K or whatever tuition amount you transfer to them as a tax credit on their own tax return. Now, you can only transfer current year tuition. So if you didn't transfer it last year, you cannot say, okay, this year I'm going to transfer 5,000 from last year's money. No, it can only be this year's own. So if you don't do it this year, you cannot transfer it to the person in the future. Okay, so some of us usually would get scholarships, we get bursaries, we get grants and all that. So we just need to take note that the difference is full-time versus part-time students. Full-time students probably won't need to pay taxes on scholarship funds. And usually the scholarship boards will issue you a T4A for those. But sometimes part-time students might need to actually pay tax, because if they're on a part-time program, some of those costs are exempted. So there's a scholarship exemption, which might be limited to just tuition and program-related costs. So all those costs like living expenses and all that, you won't be able to claim them on your tax return. So you might actually need to declare the income and pay taxes on them. Now, international students are considered temporary residents, which means that most of the tax rules would apply to them because technically they are residents as well. And then for research grants, net amounts of the grant after deducting allowable research expenses should be included as income on your tax return. So the benefits of filing a tax return as a student, you have a notice of assessment when lenders ask you, they want to determine your status, if we should be borrowing you, you have something you can provide to them. You're entitled to refundable tax credits. I've mentioned that. Usually, if you file your tax return, then, it can trigger many other benefits like the GST, the HST and all that. But if you didn't file a tax return, those things, you won't be able to get those things. Okay. And then income from RSP. For RSP purposes, if you earn some form of income at all, maybe you did some work part-time and you had some income, you would be building your RSP contribution room along the way. And I've mentioned the tuition credits for students, which you can keep carrying over to future years. So things that spouses should take note of. Cindy, if you could just let me know when I'm running out of time. So I'm trying to hurry up, but I just want you to keep me accountable with time, okay? Thank you. Spouses, so things you should think about is the spouse or common law partner amount. So this can be claimed when one spouse has income below the specified threshold. So the specified threshold for 2023 is 15K. So if your spouse is earning less than 15K, right, they will take up to what they earn, and the difference you can add on your tax return as a credit. Yeah, so I've mentioned that there's a threshold amount for this year, it's 15K. And I've mentioned that you can only take the portion that your spouse is not using. Okay, and I've also mentioned you can transfer unused credits to spouse. So for instance, tuition credit, disability amount, if you're supposed to get some disability tax credit, you're not using the whole thing, you can transfer a bit of it to your spouse. You just need to complete a schedule 2 and decide all the items, all the credits you're transferring to your spouse. Okay. And then spousal and child support. So for child support payments, they are non-taxable and non-deductible. So when you pay money to, maybe you paid money to your ex to take care of the kids, yeah, it's non-taxable. And it's non-deductible. You can put it as an expense on your tax return. Your ex-spouse cannot put it as income on her tax return as well. But when you pay spousal amounts like alimony payments, those are taxable to the receiver and deductible for the payer. So whoever is receiving it will declare it as income. Whoever is paying it will declare it as a tax deduction. Okay, and then you report those on your tax return. And so for parents, the major one will be childcare expenses. Now, so child expenses are usually done so that parents are usually incurred so that parents can either go to work or go to school. So they need to the child expenses, eligible childcare expenses are only deducted by the spouse with the lower income. Expenses incurred by the taxpayer, it could be for the taxpayer who is employed, carrying on a business or taking certain courses. So there's a maximum amount that is deductible. It's usually 8,000 per child for kids that are 6 years or younger, and 5,000 for children that are 17 to 16 years. And the childcare expense cannot exceed 2/3 of the earned income of the taxpayer. So if you're earning $30,000 in a year, your child care expenses for the year cannot be greater than $20,000. It's capped at 2/3 of your income. So you would need to have, usually the child care centers would give you receipts. It will have the parent's name, the child's name, the amount paid, and all that you would use to file your tax return. Now, amount for an eligible dependent. This is for someone who did not have a spouse or common law partner, or is not living or being supported by anyone, but has a child. That person can claim an eligible dependent amount. It's the same thing as the basic personal amount and the spousal amount, which is $15,000 as a tax credit. So the person must have supported the person in the year, and they must have lived together, unless the child is attending school. Maybe the child is younger than 18 and is in the university attending school, for instance. Because if the person was not in school, the person would have been with you, you'd be able to claim the eligible dependent amount. So you can claim for your child, for your grandchild, for your brother or sister by blood, marriage, common law partnership, or adoption. And these people must usually be under the age of 18 or mentally and physically impaired. So if they are mentally and physically impaired, you can claim even though they're over the age of 18. And it can also be claimed for a Canadian resident parent or grandparent by blood, by marriage, by common law partnership, or by adoption. So the parent needs to be Canadian resident. So if your parent is visiting, you cannot say that you are claiming eligible dependent for them because they're not resident. They're not a resident of Canada. And then we have the adoption tax credit. So anyone who has adopted a child in Canada, the cost of adoption and all that, you can include as a tax credit. So we're going to talk a bit about elderly. So usually elderly would be like people that are retiring from the age 65 and above. So who can claim the age credit? The age credit is for individuals who are 65 years and older in the tax year being filed, and they usually start getting clawed back at about 36,000. So there's an amount that they can get, but when they earn income over 36,000, we begin to claw back some of the credit. The CRA begins to claw back some of the credit that they got. And it can also be transferred to a spouse that is 65 years or older if not utilized by the other spouse. Okay, and then we have the pension amount, who is eligible. It can be claimed a credit of $2,000 can be claimed on eligible pensions received. Old age security, CPP, death benefit, retirement, excess amounts transferred from RSP are not eligible pension income. And you can also split the pension income between you and your spouse. Okay, so for those that might have disabilities, so it's not just the physical disabilities like not being able to hear or not being able to see and all that, if there's other health challenges that does not allow either you as a taxpayer or your child or your spouse, to be able to function normally, you can apply for a disability amount, a disability tax credit, and claim that on your tax return. So the person must have a severe and prolonged impairment in physical or mental functions, and it must be expected to last at least 12 months. So the way to claim the disability amount is, first of all, you need to apply for a disability tax credit certificate from the CRA. It's a form you fill out. Your medical practitioner will fill that out as well. It will be sent to the CRA. They would review and approve. Once they approve, and they will tell you when how long the approval period will be for. So they might tell you that, okay, so we're approving it from now until 2026. So that means that anytime you file a tax return for either you, for your spouse, even if it's a child that has a disability, the parent can claim it, then you would be able to claim the disability amount on your tax return. Okay. And then we have the Canada Caregiver Tax Credit as well. It's usually linked to the disability tax credit. I won't go too much into that. So I'm moving on to self-employed. So what should the self-employed guys be looking at when they're filing their tax return. First of all, you need to know that if you set up a corporation, you set up something, Felicia Inc. or Felicia Limited or 2612 Ontario Limited, you are not self-employed. At that point, you own a corporation and you are not able to file. You should not file the income or the expense from that corporation on your personal tax return because you are different from your corporation. Your corporation is an entity on its own. So this assumes that it's a small business, you're self-employed, you didn't incorporate a company. Because if you're more like a sole proprietorship, so you'll be on your tax return. If it's a partnership between you and somebody else, it will be on your tax return. But if it's a corporation, it is not on it won't be on your tax return. So what are the things you need to look out for when you're filing self-employed on your personal income? You need to first of all have a statement of business activities. It's more or less like an income statement that states your income, states your expense, use of home information, capital cost allowance tables. You need to put in all the information. Is it a professional income? Is it business income? And then you need to file. I'd mentioned that the deadline to file for people in this category will be June 15, but whatever amount you owe needs to be paid by April 30th. So what kind of expenses can you include on your tax return for the self-employed? You can include automobile expenses. Only the business use portion can be deducted. So you won't charge your old vehicle expense to the on your tax return. You need to determine what portion of it relates to business, what portion of it relates to personal, and it's only the business portion you would include. So gas, repairs and maintenance, insurance, licensing fees, you can include all that. And this is just telling you here, this is like a log. You need to keep track of what portion of your vehicle you're using for your business. So, the CRA prefers a mileage log where you kind of say, okay, this day I went here, it took me, this is the kilometers on my car. When I started, this is when I ended. So the mileage rate is this. So you kind of keep track of that so you can know what percentage of your mileage at the end of the year was used for business. Okay. So you can charge advertising and promotion to your business. Meals and entertainment can also be charged, but please note that meals and entertainment relates to you, to maybe taking a client out or a prospective client out. It's not the meals that you ate. If you went out for lunch by yourself, you're not supposed to charge that to your business, because whether you're self-employed or you're an employee, we all have to eat. So if the employees are using their own money to pay for their own meals, why should you get a deduction on your tax return? That's the way the CRA sees it. So it's meal and entertainment for taking, you take a client out, and all that to make business. And it's only 50% of that can be claimed as a deduction. I suspect that the reason is because if both of you went out and both of you ate, right? We don't want you to claim yours, basically. That's what I think is the reason why the CRA uses 50% of that amount. And you also need to be careful with classifying as advertising. So you need to be careful that you're not categorizing meals and entertainment as advertising because you're trying to get business. Even though you're trying to get business, it's still meals and entertainment and not advertising. Okay, and then you can deduct insurance expenses, whether it's general and commercial, errors and omissions, Cayman insurance. You can include, please note for insurance, you cannot include car insurance. That will fall under automobile expenses. So you won't put that in. And you cannot claim mortgage insurance here. So that will fall under business use of home expenses, just to note that. And then you can charge interest as well. So if you borrowed money from the bank for business purposes, the interest on the amount that you borrowed, the interest that you paid, you would be able to include that as a deduction. And then of course you can claim office expenses, you can claim rent. If you rented the location and you're paying rent, you would charge the whole rent expense. So with supplies for the office and then home office expenses as well. So talk a bit about the home office expenses and how you should take note in terms of the claims. You can only claim if it is the primary place you do business. So if it's just that you have a little home office, that's not where you do your business, ideally you shouldn't claim home office expense from there. If you rent an office or a space somewhere else, you cannot claim home office expense, right? You cannot use an home office expense to create or increase a loss. You can use it to bring it. So maybe after you've put in all your expenses, you then put in your home office expense on your tax return, and it takes you to a loss. You would have to adjust your tax return such that it brings your income to zero. You cannot take it. You cannot take your home expense, cannot take your taxable income to a negative, basically. So if you can't, but however, if you can't use it this year, you can carry it forward and use it in the subsequent year. Okay, so I'm going to speak a bit to homeowners, and I know that, as people have settled down in Canada, people have bought homes, people are renting homes, a portion of their homes, people are having a second property and all that. So I'm just going to do a bit of a run through on the things that, homeowners should think about. Okay, so the major one is rental income. So when you rent out a portion of your home, maybe the basement, some other rooms, you have to report that income on your tax return. And then if it's a commercial property as well, you need to, include it on your income. If you have a vacation property, you need to include it on your tax return, whatever income you earn from the rent. So the question becomes, are you carrying on a business or is it rental income? If you can show you're running a business, then you can deduct additional expenses. So I'm just going to give you a couple of ways to determine whether you're running a rental or a business. So the first one is the basic space. If you're just providing the space where the individual lives, then it's rental income. There's no business element to that type of arrangement. So you rent out your basement, the person takes care of everything by themselves. You just, so that would be a rental income. So to be considered a business, you have to be offering additional services, similar to like a bed and breakfast. So if you're the one cleaning the place, washing the sheets, providing food, arranging transportation, at that point, it's no longer a rental, it's a business. And with that, you can deduct more expenses on your tax return. Now, having more than one rental property doesn't mean that you're running a business. So if you're renting out your basement here, and then you also have another property somewhere where you're renting it out, you have another property somewhere you're renting it out, and you're shuttling, and it's still a rental. It's not a business, as long as you're not providing any additional services. When you rent out that place, it is rental income. Okay, so when you report rental income, there's a form on the tax return, the T776. You put in your income and then you put in the expenses that relate to the property that you're renting out. So if you're renting out a basement, you cannot put all the utilities or all the cost of your house on it. You need to find out what percentage of my basement what percentage of the house is my basement, and is that portion you're supposed to deduct as an expense. So if I feel that if I did the measurement and my basement is 25% of my house, then 25% of my utilities, 25% of my whatever it is, my mortgage interest, my property taxes is what I can charge as a rental expense. Now, if there's some things that I did specifically for that basement, maybe I had to make some repairs, there was a leak, I had to fix it relating to the business alone, then yes, you can charge 100% of that expense as a rental expense. But you wouldn't be able to say if you had to fix the bathroom or the washroom in your own apartment, and that because, 25% of that, no, because it relates to just your house, you shouldn't include that as a rental expense or a portion of that as a rental expense. Now, there's sometimes that you own your property with your spouse. You can split the rental income and the expenses between both of you. But whatever it is you decide to do, you need to be consistent. So you won't say 50-50 this year, and then because maybe the next year my spouse is earning lower, so I do 70 to my spouse, 30 to my spouse, so that the tax liability comes down. No, you need to be consistent. So if you're doing 50-50, you stick with your 50-50. The 60-40 you've decided, you stick to it. And whenever you decide to sell the property as well, the same would apply. Okay, so we've talked a bit about the rental income and the expenses, and usually we use the accrual method, which means that if the person is supposed to pay me $1,000 a month, whether the person has paid me $1,000 a month, right, I would recognize that as income on my tax return as $12,000. Now, you can also use the cash method where it's only what I've received so far. So if the person is owing me rent for 5 months, I would only put the rent of 7 months on my tax return, but I need to be consistent year on year. I won't use cash method this year and then use accrual the next year. It doesn't work that way. You need to be consistent on it. Okay, so we've talked about the kind of experiential expenses you can have. Mortgage interest. Please note that the principal payment on your mortgage is not an expense. So you cannot include it because it's like you're paying back a loan. It is not an expense. So you cannot include that on your tax return, but you can include the interest on the mortgage, property taxes, home insurance, maintenance and repairs, condo fees, advertisement that you use to, to get the place rented out, agency fees, office expenses, professional fees, and all that. So like I mentioned, non-deductible expenses, land transfer tax, mortgage principal, penalties on tax assessment. So if you were late to pay your property tax and they charged you an expense and they charged you an interest on it, you can deduct that as well. Imputed value of labor. So what that means is that if they called you that maybe the sink was leaking and you went in there to fix the sink by yourself, you cannot then decide that, okay, if I had called somebody to fix the sink, they would have charged me $300. So I'm going to take that $300 as an expense. You can't do that because you did the work yourself. So you're not allowed to do imputed value of labor. Or you used your children to mow the lawn and then you said if I had called somebody to do it, I would have paid $100, so you deduct the $100. You can't do that. So you cannot do the personal value of expenses as well. Yeah. So I'm not going to stay too long on this. We've talked a bit about the mortgage interest and all that. We've talked a bit about the advertisement, the professional expenses. So we also need to be careful with regards to repair and capital improvement. Now, what's the difference? A capital expense or a capital improvement is renovations and expenses that extend the property's useful life, right? And they're added to the capital pool. For instance, you renovated the basement, you put in new appliances, you replace carpet with hardwood, you change the windows, those kind of things are capital expenses. But repairs and maintenance are expensed if only it brings the property back to its original condition. So maybe you had to replace the carpet that was there was bad, so you replace the carpet. That would be repairs and maintenance. Or the roof was leaking, you fixed it, right? That would be repairs and maintenance. You have to paint the building, you repair the damaged floor, whatever. So those kind of things would be, so the repairs would be included as an expense on your tax return, but the capital improvements, you include that when you keep note of it and include as the part of the value of your property. So whenever you decide to sell it, it is considered part of the cost of your property before you determine your gain on it. Okay. Renting part of your own, I've mentioned it already, how you need to determine, what portion of your home you're renting and then charge the expenses. So selling your home when you rented a part of it. So the gain on sale of a principal residence rented out will not be taxed. So if you live in the house and you rent a portion of it out, it will not be taxed if the rental part of the property is small compared to the whole property. So if you're just, renting just a little bit of the property, then when you do sell that principal residence that you live in, you won't need to pay capital gains tax on it. Another condition is structural changes made to the property, but no structural change was made to the property to make it more suitable as a rental. So for instance, you rented out your basement and you just rented out the basement, but then if you had to, start creating walls and creating rooms and doing so many other structural changes, then you would not be able to include that principal residence as you would have to pay taxes on the gain of the portion of the property that was rented out. Okay. So if capital cost allowance was not deducted on the portion used as a rental property, because we see that some people deduct capital cost allowance, it's more like depreciation to say that, okay, a property can be depreciated over a couple of years. So we take that expense now. But the reality is that when you do sell that property in the future, usually properties appreciate, especially in Canada, right? So it becomes, if you sold it at a gain, the CRA will look at it and say that, oh, but you've been depreciating it like it was, the value was going to come down. So all the amounts you've taken over the years as capital cost allowance, as depreciation, they recoup it and they deduct it they add it back to your gain. So your tax liability will go up. So you need to take note of that. So please note that if these criteria are not met, capital gains are reported only on the portion used as a rental property. So if you're renting 10% of your house out, you didn't meet the criteria above, when you sell the house, it's only 10% of the capital gains on that property that will be taxed. You won't be charged on the whole house. Okay. Talked a bit about this. I talked about capital gains and terminal loss and recapture of the CCA. Yeah, I've talked about this. So finally, we move on to the final bit of it, which is the tax updates for the 2023 tax filing. So the deadline for filing is Tuesday, April 30th, 2024. The deadline for contributing to IRSP for the 2023 tax year is February 29. And then the limit for TFS contribution for 2024 went up to 7,000 from 6,000 in prior year. Now, in 2023, the first home savings account was introduced April 1st, 2023, which allows a maximum contribution of 8,000 per year, up to a maximum of 40,000, and it can be claimed as a tax deduction on your tax return. And then in 2023, we saw the new Canadian Dental Care Plan, which is based on income requirements. Families making less than $90,000 per year for uninsured Canadians would be able to apply for that. Application will open in phases. I think for the seniors, it opened in December, so a bit more will be happening in 2024. And then please note that this is different from the Canada Dental Benefit that offers a tax-free payment per child. Some of you might have applied for that as well, depending on family income. This was going to close in June 2024. It's been on since, I think, last year, almost 2 years ago. So that's going to close in June 2024. And then we've had the tax bracket shift on account of inflation. I mentioned that to you. So we were at about 48, 49 as the tax rate. So the 15% was on the tax rate, 15% tax rate was being charged on about 49,000 of your income. Now that has increased, so it gives us more room, right? So the tax brackets have changed, so it gives us more room, so we're not going to be paying as much taxes on the level of incomes that we had before. So the disability tax credit went digital, the application went digital, where before you would fill out a form, you take it to your doctor, you will fill it out, you will send it to CRA, you will mail it out, those things usually take a long time, but now you can do it via your CRA account, you complete your part, and then you get a reference number, you send that to your doctor, and your doctor will be able to complete the other part digitally, which then gets sent to the CRA. So the process is now faster. Before, sometimes it could take months for you to get a response from the CRA, but this kind of streamlined the process. Now, all those COVID-19 benefits, they've all expired. COVID is, according to WHO, is no longer a pandemic. So all the COVID-19 benefits have expired. There's no more work from home expenses. You know how in prior years, you could get $2 per day up to a maximum of $500. All that is gone. The Canada worker lockdown benefit is gone. The Ontario staycation tax credit is gone. That one happened where, if you went on vacation if you live within Ontario and you went on a vacation in Ontario, you could claim, a staycation tax credit. That is gone. We're back to square one. We're back to square one technically. And then we have this new multi-generational home renovation tax credit that just came up, where if you build, if you make an extension to your property to accommodate some certain kinds of individuals, you can claim some amounts on the qualifying expenditures, right? And then finally, property flipping. So starting January 1st, 2023, and what property flipping means is that you buy a property and then you sell it. So you're buying to sell, you buy it, you make a few repairs here and there, and then you sell it. That's property flipping. So starting January 2023, any gain from a sale of a house located in Canada that was owned for less than 365 consecutive days before sale is deemed to be business income and not capital gain. Now, capital gain, usually it's 50% of your capital gain that is taxed, but it's 100% of your business income that is taxed. So usually if you sold a house that you were not living in, you held it for 2 years, 3 years, 4 years, and you sold it and you made a capital gain of $300,000. 50% of that is $150,000 is what you pay taxes on. But now if you held it for less than a year, then it is determined as a business income. So you're going to be taxed on the whole 300,000 and not on 150,000. So you need to be careful, when you're buying properties for sale. How long are you holding it? Now, there's some catches to it. Like, I mean, if you can prove that it was for a reason, beyond your control, maybe the spouses split up, so they had to sell the house, or, there was a big financial need or whatever. If you can prove to the CRA that, you sold it not because you wanted it for investment purposes, but because, the situation at that time required that you sold it, then you might be able to classify it as a capital gains. You can classify but you need to be able to prove to the CRA. The CRA will be the one that will decide on how to determine whether they would go for that or not. So, final words: be informed, research, call the CRA to clarify information you don't know, engage a tax consultant. If you make a mistake on your tax return, you can adjust your tax return. It's not the end of the world. So, I mean, if you made a mistake, you realize that you filed the wrong numbers, you can always adjust your tax return. It's not a big deal. You file your returns before deadline to avoid interest and penalties. Register for my CRA account online. You can see a lot of things on your account, your CRA account online. You can see your notice of assessments. You can see RSP contribution room, your TFSA contribution room. There's so many things, you can see your tax slips that even that your employers have filed, with the CRA, you'll be able to see them as well. So it's a very useful tool for all taxpayers. Keep your receipts and documents in case the CRA should ask for it, because if you're not able to provide it to back up those numbers, they will just disallow the expense, right? So if you had childcare expenses, for instance, and they ask you to provide evidence of the childcare expense and you don't put it in the timeline they give you, they will reassess your tax return, pulling out the childcare expense from it. Okay, and stay true as much as possible. Try to reflect genuine information. Don't hike up your expenses. Don't reduce your income. Try to be as truthful as possible. So I guess this is the point where, so someone at Abimbola had mentioned, I run FAB CP accounting, and I provide personal income tax filing services, corporate income tax filing services, GST, HST reporting and filing, payroll administration, and tax planning as well. So you can reach out to me if you had any questions or you wanted me to assist you with your returns as well. So we go, sorry. One sec. So we go to questions, and I'm sure there will be questions. There are always questions.
Yes,
So,
there are a lot of questions. Thank you so much, Felicia, for a very, very intense and insightful session. I learned a lot. I don't know about the others. I'm quite disappointed about some of the updates like that work from home experience. I was already planning around. Around it. So anyway, so I'll go straight to the questions because we have quite a lot of them. I do notice though that some or one of them have been answered towards the end of this session, but I will just go ahead to start reading out them. So I'm going to start from the first one I have here that I captured. It's, can you send an objection to the reassessment? That's to the CRA if you did not include your T5 because you did not get it. That was from Blessing Amabo. Would that be T5 or T4? That would be T4, right? Or is there a T5 form?
There's a T5. So T5 is the one with the bank. So if you have income, maybe you had some deposits and they were giving you interest, then you get a T5. So if you didn't get it, doesn't mean it didn't exist. So you won't be able to file an objection, right? So I guess you would have to go to your financial institution to find out, why you didn't get a T5. Is the T5 real? What does it relate to? They'll be able to explain to you. But if you earned interest if you earned income from the financial institution and they provided the CRA with a T5, because the CRA has a T5, then I mean, I'm not sure the objection will go through, right? I think it would be a waste because you did earn the income, even though you didn't report it. Now, if you go to your CRA account online, there's a place where you can actually check your tax slips for each year. Most likely the T5 will also be there. So even though you didn't receive a physical copy, I always encourage people that before you submit that tax return, log onto your CRA account online, take a look at all the tax slips you see there. Some might not be there, even though they were sent to the CRA, but majority of them are usually there. You will see your RSP contribution receipt, you will see your T4s. In fact, there are some things that you will see that you're totally forgotten about. It's when you check that you realize that, oh my God, actually worked in this company or actually earned some money here and all that. So I advise that you go back to your CRA account before you file your tax return, just to be sure that you kind of covered everything. So I don't think you'll be able to file an objection, because if the T5 is real and it exists, then there's no case.
Okay. All right. Thank you so much, Folusho. I think that answers Blessing's question. Next one is someone is asking if you can share the presentation of this after the session. That's Riti Oluwar.
No, sorry, I'm not able to.
All right. Okay.
Yeah,
Totally
about
understand that. Yes, because that's so if I withdraw from my RRSP and I'm charged withholding tax, will I pay tax on the amount again because I need it as income when filing my tax? That is Oluwaseyi Awotunde.
Okay, so when the financial institution did withholds a tax, it's like usually like a random amount, like maybe 15%. They're not sure what your tax situation is, but they are mandated to withhold some tax. Now, when you file your tax, when it's time to file your tax return, that financial institution will give you a slip. It's called like an RSP income tax slip. It will show how much you got paid, how much you withdrew, and how much was deducted as tax. Now, that tax that was deducted will be factored into the total taxes that you paid in the year. So if you're going to owe more, then you would know at that when you're filing your tax return. But the financial institution would not be able to tell, right? So they've deducted a notional amount, so to say. But then all the taxes that you've paid, you would include on your tax return. All the income that you earned, you would include on your tax return. Now, depending on your tax bracket, depending on your tax situation and all that, would determine whether you would be required to pay more or less, or get a refund. So you won't be able to tell till you kind of put all your income together, both the RSP income and the employment income and the self-employment income, whatever income that you have earned in the year. So that's at that point you would be able to tell.
Fantastic. Thank you so much. Still on Oluwaseyi's question, he's asking which is better to file, whether it's individual or with spouse. So what would be your advice in this regard?
So usually when you submit a tax return, each person has a social insurance number. So we all file individual taxes. However, when we are filing tax return, I usually advise you file as a couple. Now, at the end of the day, it's 2 tax returns that will go to the CRA, one for you, one for your spouse. But then when you file together, like with spouses, you're able to move tax credits around. So this person doesn't need this tax credit, we can put it in the spouse's own who needs it. This person doesn't need this one. It would be better off, this person's a lower income earner. It'll be better off if we put it in this one to get the best possible tax outcome for the family. So yes, I would say whether you're using a tax preparer, whether you're doing it online, kind of, ensure that you're doing it as a spouse so that you get the best tax outcome as a family. But at the end of the day, it's still 2 tax returns that will go to the CRA, one for you, one for your spouse.
All right. Thank you so much for that elaboration, Sheyi. I hope that answers your question. The other question Sheyi asks is, there's a new housing rebate, GST, HST rebate application affect my tax filing?
No. So those GST rebates are usually you don't declare those income. You don't declare those income on your tax return, so it doesn't. So it's just money. So just like the childcare benefit and all that. Yeah.
Okay. All right. Thank you. Adeyemi Olaniyan is asking for the GST HST form. I think he or she has challenges with filling the form. Would you want for this person to reach out to you to have that?
Reach out to me because I'm not sure it's something we can do on the call.
That can be covered here. So Adeyemi, please reach out to Folusha so that she can assist you with that piece. And another question from Oluwaseyi is that does my property tax affect my filing? And do you need to have receipts for moving expenses? Those are 2 different questions.
Okay, so when you say property tax affected, so the only time property tax would affect your tax filing is if maybe a portion of your property is being rented out. It's at that point you'll be able to take a portion of the property taxes as an expense. But usually if the only one, just you and your family living in the house, the property tax has no impact, and you're not working, all the working from home is gone. I mean, Yeah, so it usually doesn't affect your tax return, so to say. And then for moving expenses, yes, you need to keep your receipts because the moving expense bit is a highly reviewed area by the CRA. They
Okay, and you
want
keep the receipts for 7 years.
yes,
Just want to clarify, 7 years as
yeah,
well. Okay.
yes. The rule is 7 years, but I don't think they come back, more than a year or two.
Yes.
Right? But it's just safer to keep your receipts. Now, I know that moving expenses, employment expenses are high areas that the CRA reviews, they tend to review it more than other areas. So it's better for you to ensure that all your ducks are in a row in those areas.
Okay, so this is a longer question from Ebenezer Ibeneme. He's asking that if a couple landed in February 2023 for PR purposes and then stayed for only 2 weeks and then left the country for the rest of 2023, they didn't open a bank account or rented a place in 2023. Are they residents for tax purposes for 2023?
So this question, I usually will send the person to CRA to ask the question. But from what I know, right, and I don't want you to quote me, but from the experiences I've seen, the experiences I've had with clients over the years, if you came in February 2020 and you stayed for 2 weeks and you left, technically you were not resident. I mean, technically you were on vacation. So you were not resident for tax purposes because you didn't set up a home, you didn't set up a bank account, you didn't set up you didn't do it. You just kind of came for 2 weeks and you left. The intent wasn't to remain in Canada to leave. At that point, you left after 2 weeks. So the answer would be you are not resident for tax purposes. But then I always say, better to confirm from the CRA because they might ask you some other questions. I'm talking based on what you've said. They might ask you some further questions that might prove that the answers you gave, might suggest something else. So based on the information you've given me, 2 weeks and I was out, no, you're not resident for tax purposes, but I would still suggest you call the CRA when
Okay. All right.
Yeah.
Thank you so much, Felicia. So, Ebenezer, please feel free to reach out to the CRA line. Just going to quickly also drop in this question from, okay, I think it was from John Yu. I think it was John Yu I saw. This person is asking about carbon credits. Do you have any information concerning carbon credits? His question was, what about carbon credit? I'm not sure what the full.
So I would think that the carbon credit falls under the climate action incentive.
Okay.
And it used to be a refundable tax credit that we added to your income, added to your tax refund. But then they stopped doing that, I think, last year, and they decided we're going to be paying every quarter to everyone who qualified for it. So usually the carbon tax credit would fall under the climate action incentive. So that more or less one and the same.
Okay. All right. Thank you so much. Ebenezer Ibeneme, staycation. I think she answered that question. Staycation credits doesn't apply again for 2023, right?
Yeah.
So I think she answered that earlier. And then Chioma Concord is asking if paid rent is claimable.
So claimed rent it's not like a claim, right? So for residents of Ontario, there's this Ontario Trillium benefit. And usually what they use to determine the benefit also includes either the rent you paid or the property taxes that you paid in the year. So it's not like when you file it, you're getting a refund or it's affecting your tax return. No, it's for them to be able to determine what kind of Trillium benefits, what's the amount of Trillium benefits we should be paying you on a monthly basis, basically, or quarterly basis. So yes, so there's a portion of your tax return where you would fill out that Ontario Trillium benefit, where they can include the rent that you paid in the year, but it doesn't affect your tax return. It is used to determine your Trillium benefits.
Okay, OTB. All right, thank you. I hope that answers your question, Chioma. Someone was asking also, which form or section will I use for school fees?
Kind of school
That's
fees.
T2202, right? 22202.
So if you're an education, if you're in the university, it will be the T2202. that you'll be able to claim. Now, if it's for a child in secondary school is supposed to be free. You know, elementary school is supposed to be free, but some people send their kids to a private school. You can't claim. You can't claim whatever you paid in your private school unless the private school gives you some kind of receipt that if, and I know that private schools do that, they will, a portion of it to be called donation, a portion of it to be called something else, you know, so that you can claim something. But usually school fees paid to private schools for kids are not tax deductible.
All right, thank you so much, Felicia. There's this question from so the next question is, how about home office expenses that aren't reimbursed by your employer when you're working from home, not your personal business? And that's from Fee.
Could you repeat again?
So she's asking about home office expenses that aren't reimbursed by employers when you're working from home. So work from home expenses, basically,
Okay.
not your personal business. She's asking if you can claim this. I think this was already clarified at the end, right?
Yeah. So even though the work from home expenses is gone, right, we still have employers who have given their employees the right to work from home. So in those kind of situations, they will give them a T2200. And to be clear that, you know, you're supposed to work from home and the cost of working from home is to be borne by you. Now, if they reimburse, you cannot put it on your tax return. But if they say that, you know, you're allowed to work from home, they kind of detail what the kind of things you can do from home and all that, then yes, you'll be able to claim some of the work from home expenses on your tax return. But if you don't have a T2200, it's a condition of employment kind of form. If you don't have that signed by your employer, you won't be able to claim it on your tax return.
All right, thank you. And then we have Chiamaka Emencheta asking how to file utilities, gas and hydro in our homes. How do we file that?
You would only file that if you were using it to generate, if you're using your home for business purposes. So your utilities normally would not be factored in. The utilities you pay will not be factored into your tax return normally. The only time it will be factored in is if maybe you had a business and you were running it from the house, and then you have to determine what portion of it, you know, to include as a business expense.
Okay, thank you so much. Oluwaseyi says again that just to be clear, if you rent out your basement, you can charge a part of your property taxes as rental expenses. Is that correct?
Correct.
All right, Shay, we are clear on that. And then we have Ubo Kabang Ezekiel asking, is income earned from remote jobs taxable? How about passive income earned during that's from Uber, DoorDash, and the likes?
All income is to be declared. Worldwide income. So whether you earned it here, or you earned it in the US, or you earned it in Nigeria, any part of the world, as long as you're resident for tax purposes, you're supposed to declare all income earned.
All right, thank you. All right, Dominion is asking, can you claim roof repair that is paid for by insurance?
The answer would be no, because insurance has paid, so it wasn't out of pocket.
Okay. And then the second question is, can you claim car repair that is paid for by insurance?
No, same thing, because you didn't incur the expense at the end of the day.
Okay. And then can you claim fine paid to government, e.g., $5,000 paid for driving with suspended license?
No, you cannot claim that. I think there was a portion of my slide that said that penalties cannot be,
Claimed, yes. Okay, and then Dominion for the remote virtual office expenses, we've spoken about that. The fifth question, what is the maximum that can be claimed under moving or relocation expenses? I think you stated 5,000. Is that correct? Or the amount of, depending on your earned?
Depending on your income. No, let's take a look again. One sec. I'm not sure there's a limit though. Let me see.
Okay.
Let me just go back.
I think I saw some,
Yeah. also claim a maximum of 5,000 in care to maintain an old residence. No, so there's no limit. There's no limit. So this 5,000 is to maintain an old residence,
Okay.
right? Yeah, so there's no limit. But what we also said was that you cannot claim beyond your income. So you can moving if you can't claim beyond, but you can carry forward. So if your income is that you earn from where you moved to is 10,000 in that year, you cannot claim more than 10,000 moving expenses, right? But if you incur 15,000 moving expenses, you can carry the 5,000 forward to next year to use.
All right, thank you again. And then we have Baba Sonia saying, can I file for transportation expenses as a student? And what form are we using to file?
I'm sorry, could you say that again?
Can I file for transportation expenses as a student?
No.
Okay. All right. So you cannot file for transportation expenses. Chioma Okonkwo is also asking, what are the specific things a student who is unemployed should file for to prevent leaving money on the table? And for the second question, for someone filing a tax on their own, okay, I think she's answered this question. She said you can use TurboTax and WorldSimple and some other applications. But for the first question, Felicia, what are the specific things a student that is unemployed? What do you file for?
Usually you would file your tuition certificate. That's the major one because that's the chunk of school fees. Is a big deal. It's the amounts are usually large. If you received grants, you would have to file those on your tax return because usually we would have been issued a T4A for those as well. So I guess that's basically, I mean, if you didn't have income, most of the non-refundable tax credits won't apply to you, so you can't claim anything really. But you could also, so it's majorly the tuition. If you have donations, you can put it in. Just put in everything that you have, even if you don't have income, because some of these things carry forward to the next year, and you don't know what next year will look like. You might have income by then, and then you would be able to use some of the things. So whatever you have, just put it in all the donations, moving expenses, whatever it is that you have, just put them all in on your tax return, and then you could use them in the future.
All right, thank you. Very interesting conversation so far. I myself am learning so much even from these questions. Thank you so much, Felicia. So the other question that we have is from Dominion O. Is asking that which one is better, to feel all your income as a corporate income that attracts 12%, or to do it as personal tax? So which one?
So it depends. So there's no one answer. What are you trying to achieve? What's the, there's so many questions that would need to be answered before, one can advise on that. So I'm not sure it's a question we're able to take here.
Okay. Thompson Okoka is asking, he said, first of all, thank you very much, Felicia. And then he said, great job. Is there a way to link our tax details with our home country? What would be your advice for a fresh student who has been making contribution back home? Question from a novice.
Contribution to what?
That's a very good question. Thompson, are you able to unmute and let us know what kind of contribution are you talking about? Would that be savings? Would that be investments? Would you be able to share? Is Thompson still in?
So I'll just answer the first part of it, which is, for now, there is no, I don't know that there is a link between the Canadian system here and the Nigeria, because it's talking about back home. I'm not sure there is. If there is, I'm not aware that, they can share information or pull information. I don't know that that is possible as at yet. But in terms of contributions to Nigeria, I'm not sure what that means, so it's difficult to answer.
Okay. Thompson, you can provide more clarity. If you can't speak, you can just drop it in the chat and then we would answer that question. Benny is asking, for subscription fees to professional associations, must the fees have been paid in 2023? Can we claim those paid in, say, 2022?
It should be 2023, but then if you realize that in 2022 you forgot to put it in, you can adjust your 2022 tax return.
Okay,
You
awesome.
can adjust return and then they would reassess and then, recompute. If you're supposed to get a refund, you will get it. Whatever it is, they will let you know.
Okay, at this point, I think that Felicia needs a drink of water. She's been speaking for over 1 hour. And there are
I'm
still
good.
more questions. All right, thank you. Thank you so much. So Johnson is asking, now, if you work for commission, what is the best way to pay tax? The employer wants to deduct tax before paying commission. Is that okay? What is the best way when you work commission?
Yeah, so there's no hard and fast rule. I think employer, deducting taxes before paying you is a good thing, because if you're not disciplined in knowing that I'm going to pay taxes when I file next year, you would have spent all the money you received. And then when you file your tax return, you're going to owe because your employer did not deduct any taxes. And then it will be a struggle to come up with the amount that you owe. Whereas if your employer had been deducting the taxes, you kind of have something in the bucket already. So when you file your tax return, you kind of pay taxes ahead of time, right? So you might not owe, you might get a refund, depending on your tax situation. So I would say that, especially if you know that you will spend the money, right? You might as well, let your employer deduct it. Some people that their employers don't deduct actually make voluntary contributions, installment payments into their CRA account, so that when the time comes for their taxes, they don't just get a whooping bill of $6,000 or $10,000 that they don't have anywhere to, they can't figure out how to make the payment. Whereas if they've been $1,000 every month from what they were earning, right, it makes it easier for them when they're filing their tax returns.
Okay. Okay. There's another question from Obiora Obi asking, for students who landed last April, are we supposed to file for this year?
Yeah. So what we're filing this year is for 2023, January to December. So if you landed anytime between January and December 2023, you're required to file a tax return.
Okay. Damilare O is asking a question, says, for a student working full-time, will he or she have to file tax in both ways? I'm not sure what he means by both ways, though.
So I guess he's thinking that you will file as a student and file as an employer. But the answer is that you're filing as an individual. It's just you, just one you. Your student T22, blah, 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 will be in that same tax return. Your employment income that you earned while working will be in that same tax return. So everything's inside one tax return. So you just put your income in, you put your tuition credits in, you put everything in, and you submit one tax return.
All right, awesome. Thank you. We have someone who is requesting if she can participate as tax preparer. She wants to volunteer to join you. I'm sure she's
I
blown
guess
up.
we can talk about that. My details are on there, and so we can take that.
Yes, feel free to take a screenshot, and that goes to everyone. Please take a screenshot of the contact details on the screen. Feel free to reach out to her concerning all the services that she provides here on your screen. We have other questions. I see that we have Rahim's hand raised. Let's quickly take Rahim and then we'll go back to our questions. Over to you, Rahim.
Oh, sorry, Cindy. I thought you were done with the questions and you were
No.
analyzing. I was going to wait till all the questions came, and if my question was answered, I was just going to let it be. However, she answered one of the questions, which is the work from home. So just to clarify, Felicia, thank you for this presentation. I thought I knew about taxes until I listened. You can see I'm no longer lying in my bed. I've been up to get all the
Sitting
information
up
and soak it
straight
all
at
in.
attention now.
Exactly. I have to just soak it all in. So for the work from home, I guess the catch is just look out for the T2200. Is that correct?
Correct. Yeah.
Awesome. Thank you. Now,
And
another one.
And ensure that it also mentions that you're allowed to work from home.
Okay.
Because
okay.
T2200
Awesome.
can be other things. It might be very cool. It might be,
Mm-hmm.
different other kind of things. If they don't specify the work, being able to work from home, won't be able to claim it.
Okay. I guess someone in HR will be answering a lot of questions on Monday. Okay. So You also talked about the investment property. It's quite sad that they're moving it from capital gains to business income.
That's
Now,
if
my
you hold
question
it
is,
for over a year, for less than a year.
now that's where my question comes into play. You do understand there's some investment properties where they are like pre-owned. You buy before it's constructed, and it could take 48 months before it's constructed, and just before you finish construction, you sell it. Would that be deemed disposition after owning it for 3 years? Because you know it wasn't even built when you bought it, or you're selling it even before the completion of the building. So the building itself is not even in existence for up to a year. How do we handle that for tax purposes?
That's a good one. So it also depends. So you technically you didn't own the property, right?
Up until closing, right?
Up until closing.
Yeah.
So at
But
what point did you?
you're not even waiting for it to close. You're selling it on assignment sale.
I'm not sure. I can find out because what I know is that even the property developers try not to do that anymore, right? Because of there's a lot going on around that space. Even the property guys don't want to do on us, and they want you when we close, you can sell it, but in between
That's what they do.
anymore. But I would guess that from my own knowledge, I would think that if you held it from maybe for 2 years, 3 years. I mean, it can be argued. So that's the thing with CRA. So there, if you can prove your point, if you can agree and say that, okay, look, I plan to hold this thing till closing and actually live in it, but then something happened, I'm unable to hold it, I need to sell it, maybe for whatever reason, I needed the funds, my lifestyle, my life situations happened and all that. So there's no hard and fast rule. If you can convince them, provide evidence to back up, the reason why you sold it. But then if they can tell that, you just bought it and then you're selling it just to make money, then it's like a business, right? It's like more like flipping. We buy it when it's really cheap at the beginning, and then as we get towards closure, we know that the value has gone up, and then we sell it. So they will consider that as business. But if you can prove that, that was not the intent when you started out with it, then they'll be willing to listen.
All right. Thank you very much. I do appreciate that.
You're welcome.
All right, thank you so much, Rahim. I see that we have Damilare's hand up. I guess that would be concerning his question, the one I'd read out. Damilare, if you can go ahead to unmute. After Damilare, we'll go back to the other questions we have in the chat. Over to you, Dami.
Hi, ma'am.
Hi.
Oh, thank you so much for everything. As regarding the question, I was asking, the two forms are different, I guess. Because at my workplace, they said I'm having a T4, and at the school, I'm having a T2202. So that is what I just want to clarify. How do I match it up?
No. So when you're filing your tax return, right?
Yeah.
You will put inside that same tax return the details of the T4, and you would also put the details of the T2202 inside the same tax return.
Inside the same tax return?
Yes. So there's a portion for employment income, which is the T4. There'll be a portion on that same tax return, which will be for tuition credit, which is the T2202. So you will put everything into that same tax return.
Sorry, I need to clarify. Like, am I getting a form for the tax return?
Yeah, so there are different options. You can either get a form, print it out, and fill it out manually. I won't advise that. Or you can go to use a tax preparer to do it, pay some money and get it done. Or you can, do it online with TurboTax, Simple, HRNR, Block. They have some free, packages online depending on your tax situation, right? So so for those online ones, once you click on them, they kind of ask you questions. And you just answer the questions and they tell you, okay, do you have the T4? You say yes. Can you put the details in? Do you have the T2022, T2202? Yes, you put the details in. And they kind of guide you on how to go about it.
Oh, thank you so
much. I think maybe you're thinking it. Just once it's time to file the tax return, if you decide to use one of those online, online platforms, you would notice it's pretty straightforward, especially if it's just a T4 and a T2202.
All right. Thank you so much, ma'am.
All right. Thank you. And now we're going to go over to the question session again. We have a question from Chioma Okonkwo, and she's asking that while including rents paid, is there any proof of tenancy or payments needed?
So if you're filing a paper return, yes, but most people don't file paper returns anymore. So the answer is no, but you're supposed to keep it because the CRA could come back and say, oh, we're reviewing the amounts that you claimed. You said for a rental purpose. Can you provide evidence that you actually did pay rent in those periods? And then you would have to provide it to them, and they'll give you a deadline to provide the documents to them. So you would need to do that. So it's better to keep it. So just have it on hand with you.
All right, fantastic. And then we have a John Lloyd saying that he paid rent in cash and a receipt was issued. Can I be able to get a tax refund?
A receipt was issued.
Yes, for the rent he paid in cash.
Yeah, so like I said before, the rent that you pay in Ontario is not for you to get a refund. You will not get a refund. It's to determine your trillion benefit, right? That you'll be paid on a monthly basis by the CRA. So after they've assessed your tax return, they've seen what your income is, and they'll take a look at what amount you're paying as rent, and they'll use all that to determine what your trillion benefit will be that they'll be paying you on a monthly basis. So if you paid rent, doesn't matter if you paid rent in cash, as long as you have a receipt to back it up, you can include that on your trillion benefit application, and the CRA will use that to determine what your benefits will be, but you won't get a tax refund by paying rent.
Okay, someone is quite curious about property taxes and wants you to elaborate further on it. That what is property taxes? Who pays it? Can you give a little summary about it?
Property taxes is for owners of properties. So if you purchase a property, then you would pay property taxes to the city where the property is located. Now that property tax is kind of used to run the city, so to say, garbage, education, all those, we're fixing the roads that you see going on within your cities. It's the monies that they get from property taxes, all the free education the kids are getting and all that, it's from the property taxes that they get that. So it's only applicable to owners of properties. So when you purchase a property, the city will be notified, and then they begin to send you the property taxes for the year that for your property.
Wow. Okay. All right. Thank you for sharing that. Now, Mom is an international, well, I don't know if she's an international student, but she has that question. She's saying, as an international student, is fund receipt from Nigeria taxable?
No. Is it income? If it's not income, no. So if your dad is giving you money
that is
for
not
upkeep,
taxable.
no,
That's a gift.
no,
That's good.
it's not taxable.
Okay. Now, if it is, maybe she's earning some funds, she's making some money, doing some business in Nigeria,
Then
and
she would
she brings that fund into, it is taxable.
Even if she doesn't bring the funds into Canada, as long as she earned it.
Really? Mommy, you
Yes,
had that.
it's supposed to be included on your tax return.
Okay. All right. So that is another one. And then Johnson is asking, okay, NIROW has responded to that. For Doris Ahuchama, she's asking for those on closed work permits, religious and being paid stipend, not full salary. Are they supposed to pay tax? If yes, how?
So could you repeat the part? I heard the closed work permit, but you said something about religious.
So closed work permits, apparently working for a religious
organization.
And
Okay.
she or she's been paid stipends, not full salary. She's asking, or he's asking, I think Doris should be a female anyway, asking whether they're expected to pay tax, and if yes, how can they do this?
So you're expected to file a tax return.
Okay.
Whether you pay tax will be determined at the point of filing a tax return.
Okay.
Right, but you're required to file a tax return. And then I had mentioned during the presentation, there are different options of filing taxes. Let me just put the slide back here. Yep, so this is the slide.
Yes.
These are the options available to you to file a tax return. So yes, you would file a tax return. Whether you would pay taxes or not, you won't know until you put in all the information.
All right. So we are at the last minute. We have actually gone over time. We plan to end for 1, and we see that more questions are coming up. There are other questions here. Rose, if you could drop your question just for the benefits, just for the sake of others that had dropped their questions earlier. I might not be able to take yours, but I'm just going to look through any question that I see that is not repeated, and then I would, ask that question. And if you have any other questions, you might have to reach out directly to FAB so that they can, help out with those questions. So I'm just looking through to see if there's any question that is not duplicated at this point. So Blessing Omobor is asking, please, how do you know the tax to deduct and contribute to your CRA account if you are a personal contractor and taxes are not deducted from your income?
So you'd have to estimate. So this is the tax rate, for instance. You can also find it online. This is for 2023. So you can just estimate that, okay, I'm earning about 50K. I will put 15% for federal and maybe 5% for Ontario. So maybe I'll do like 20% of whatever I get. I'll put it in my tax account. You can't know the exact situation till you file your tax return because, there might be other things that might come up. You pay childcare expenses, you did donations, you had RSP contribution, so many other things will come in, but it's just for you to estimate such that the burden when it's time to pay the taxes is not too high for you.
All right. Okay, thank you so much. So I'm going to take one last question so that we can wrap up. After this question, please just reach out to Felicia. This looks quite unique, and that's why I'm going to say this because I believe that everyone can also benefit. If a sole proprietor earns in foreign currency, I understand that the Bank of Canada exchange rate is to be used to convert the earnings into CAD. However, their rates are higher than what the commercial banks offer, meaning that you'll be using a higher CAD equivalent of your income than you actually earn. Is there a way around this?
Unfortunately.
No.
So because on all tax platforms, whether from the tax preparers or even online, the CRA has already, so the CRA uses the average exchange rate, right? So if it's USD, this average exchange rate is USD, the rate for average exchange rate for January, February, March, and then for the whole of 2023, for instance. So that's the rate everyone has to follow, even though that might not be the reality, but that's what CRA would use.
All right.
To do it, yeah.
All right, so I think that will be all the questions that we would take for today. Thank you so much, Felicia Akinyele, for a very, very, very interesting and insightful session. So much was, learned today, and I believe that everyone agrees as well. If you would just put up that your contact information just for the last time, just in case some people forgot to take a screenshot, please. Everyone take some time to capture that and have that contact information saved. If you have any questions, you need to file your taxes, feel free to reach out to them. And big thank you to everyone here who was able to join the session. Thank you so much, first of all, to NIROW and to NNC executives for putting this workshop together. If we had to pay for it, we'd be paying more than $1 million, I'm sure. Thank you so much. And thank you to you, Felicia, for, putting this together. We really, really, really appreciate the time, the efforts, and, the energy you've put in here. And again, thanks again, of course, to everyone. Thank you so much for joining and enjoy the rest of the weekend.
All right. Thank you. Take care, everyone.
Thank you. Have a great one.
Thank you, everyone.
Sorry, just a quick reminder that we have a feedback form. Please complete the feedback form. That is to help NIROW and networks of Nigeria and Canada to plan all of these workshops better. Please fill the feedback form. And Thank you so much,
This is
everyone.
really important so that we can support you better and make sure that we are giving you value. So please, please, please don't just take freebies and move. Fill the form. All right. Thanks, everyone. Enjoy your weekend. Thank you.
It's invalid.
Bye, everyone.
It's saying invalid?
Yeah.
Oh.
So maybe if you could share, I don't know where else we're going to get it if we leave the chat, but it will be maybe via email.
It will be sent via email to
Okay, that's
everyone.
because the link in the chat says invalid. Thank you. All right. Bye. Thanks so
Okay,
much.
thanks
Thank
for letting
you.
us know.
Bye.
Yeah.
Yeah.
Okay.
Remove the full stop at the end of the link. I think that's what's making it invalid.
Are you able to access it now? Okay.
I can access it here.
Thank you, Cindy. You did a fantastic job too. Thank you so much.
Thank you. Thank you. Thank you. Thank you. Yes, it's working now. It's just the full stop. Okay, I think we can send this across board to the group. That's what we just do. To the Telegram group. Afolabi, you dropped your email address.
I think we can close the room now.
Okay.
All
right.
All right.
I
Thank
shall
you very much,
remember-
Cindy.
Remember
Thank
to
you.
send the link. So remember to upload on YouTube and send the recording to NNC as well.
All right. Thank you.
Bye.